I'm really happy to be here at Ag Excellence, particularly because of the theme of challenge of change. And it really has become so important as we emerge out of this pandemic. And after a crazy year, weather and markets, we all have to be prepared for change. Today, BDO's put together a trio of trusted ag accountants to help you understand your farm financial health. Basically to diagnose potential problems, see areas of improvement, and yes, help with your future decision making. Like going to a doctor for a physical exam, a financial checkup will give you certainty. You'll understand what's going on internally so you can focus on changes that can help and fix little problems before they become big problems. A checkup should give you peace of mind, especially needed during times of amplified change like this. Inflation, supply chain disruption. You know, we've heard it all: market volatility, rising costs, God bless fertilizer, changing consumer demands, labor struggles, weather uncertainty. These are all forefront of mind today. So instead of doing a knee-jerk reaction, knowing how your farm stands financially today and in the past can help you focus on what you need to change going forward and let your numbers empower your decision making. As you note at the bottom left, BDO is celebrating 100 years of helping people with their accounting. And so we're kind of, I like to say, we're like a century firm, and our farmers are all century, many of them are century farmers. So it actually works really well. Today, we've gathered a team together who will clearly explain what your financial statements are telling you in layman's terms, and use examples so you can understand your debt and operationally when you're going forward. First of all, we have Mark Verwey. He is the National Agriculture Industry Group leader, and he's a partner in Manitoba. He is just a brilliant mind and a genuinely good guy who really wants to help farmers be successful. Then we have Reykdal. She's a senior manager and an ag team leader in Portage la Prairie, Manitoba, and she is one of BDO's young gun rock star accountants. And she has been leading the way on how to help farmers interpret and use their financial statements. And then finally, we have, last but not least, Lisa Kemp, who is a partner in our Lindsay, Ontario office. She farms with her family in Blackstock. Yay, Blackstock. She's an integral part of our ag leadership team at BDO, and her practical knowledge, her leadership skills, and her get her done attitude has really been the driving force in BDO creating the country's first quality farm financial benchmarks. I really cannot overstate the respect I have for her. As these three present, please ask any questions in the chat box. I'll be moderating, so I get to pull out your questions after. I'll ask them on your behalf. So please keep them rolling. Lots of questions means that you're really engaged and want to make changes based on your numbers, and that's a wonderful thing. At the end, we'll put the three of these big brains on virtual hotspots and ask them these questions. So if you want to ask directly, just put your hand up and maybe we can do it that way as well. Or you can text me your question. My cell number is 905-213-3711, and feel free to do that. After today, if you wake up in the middle of the night like I do and go, oh, I should have asked that question, please reach out to any of these three independently or myself at mvancamp@bdo.ca, and we will do our best to answer any questions you have on the financial health checkup, on benchmarking, and really how to diagnose problems within your own farm. So take it away, Mark.
Thank you, Maggie. Yeah, the financial checkup that we're going to present today is a work in progress at BDO, but we want to share some of the highlights of it that you could use within your own internal operations. The table of contents, so there'll be an introduction and the importance of sound financial reporting. We'll talk about standardized financial statements as the foundation. Kayla will review the diagnostic review. We'll then get into benchmarking with Lisa. I'll talk about financial ratios. Then we'll end with key performance indicators, and then we'll conclude after that. So Studies have shown that there's a direct correlation between the financial knowledge of a producer and their ultimate success. So with that correlation relationship, we think it's important that we try and provide you with as much financial information or resource that you can use to be successful. So one of the goals of the financial checkup is to give you some peace of mind that you're on the right path to success with your operation. Conversely, we also hope that this financial plan will provide you with early warning signs where things need to be changed to get you on the right course. But either way, the hope is the process provides you with a level of peace of mind with your operations, and that for the health of yourself, I think the financial checkup will be of assistance. Now, the importance of sound financial reporting. Sound financial reporting creates accountability to the decisions you make as a producer. Gone are the days that you can simply look at your bank balance to see that you're successful. It takes a lot more than that. And some of the points up top, you cannot manage what you can't measure. Every key decision you make has a financial consequence. That's important to know. It's always important to stay current with your financial information in real time to make the right decisions. And it also improves your position for growth to have sound financial reporting that you can take to your lender. Farming is so much more complicated now. As well, dirt doesn't necessarily imply success anymore. You have to look at how you employ that dirt. The margins are so small for farms right now that it's incredibly important to be on top of your financial information so that you are evaluating your decisions. So the key to sound financial reporting is starting with your financial statements and having those financial statements standardized. Those statements are a report card on your financial position. They're also a report card on your operating performance. Accurate, informative financial statements are the foundation to your success. It's like when you are building a structure, you start with a strong foundation, and the financial statements are that foundation. The session that we'll talk about today, it'll mostly deal with incorporated farms, but many of these concepts are relevant to unincorporated farms as well. And your financial statements are also your key source of information to your lender. So the two key documents to a financial statement that you would review with your accountant every year would be your balance sheet and your statement of operations. And we'll go into a little more detail on each one of those. So the first one we'll talk about is your balance sheet. That is a point in time document that should be time sensitive in terms of its layout, and it really exemplifies the financial strength of your farm. So that's a great starting point that you need to look at. You can see in the next page on the balance sheet, we start with the assets. I always start with the assets at the top. They're segregated between current assets and long-term assets. Your current assets are assets that could be liquidated within the next year, and that's important to have that luxury that you can do that. The longer-term assets like property are much harder to convert into cash, and you not necessarily don't want to do that. The longer-term assets are usually measured at original cost, less any amortization or depreciation, or what we really call wear and tear on your equipment. So that's your starting point. That's the good part of the balance sheet. That's what you have. That's what you own. Then we get into the second component of your balance sheet, and that's your liabilities and your equity. So you can see from that your current and long-term liabilities are shown there. Your current liabilities are liabilities that are due within the next year that you'll have to extinguish those responsibilities. So it's always important to have a grasp of that. You also see on that financial statement amount due to shareholders. In most cases, the banks will regard that as equity, and they will include that with the shareholders' equity that is just shown below. And shareholders' equity really includes the accumulated profits of your operation that you have left in the company to grow your operations. So the balance sheet at the bottom made up of liabilities and your shareholders' equity. Then we proceed to the statement of operations. So this is your performance for the year. This shows your activity and measures your activity. And you can see we start with crop revenue at the top. We get into your cost of goods sold, coming to a gross margin. I will provide more detail of these numbers. Then we get your direct operating expenses, which comes down to your contribution margin. We then have overhead expenses, which are a little more fixed, that results in your operating income. Then we take your capital related costs, and from that we come to income before other income and expenses. Then we have other income, and that's really some of your one-off income that don't occur on a recurring basis, like gain on sale of equipment. And that would leaves you income before income taxes, then your income tax, and finally your net income. What you'll notice with this statement, it's decision focused, which means that numbers at the top are more influenced by the decisions you make. That includes crop selection, input costs, and variable expenses. I would argue on this page, the most important number is your contribution margin. That's the number you see there, 581,500. The success of your farm is contingent on the strength of this number. So I'm going to talk about this number a little more because most of the decisions you make will impact this number. So again, we talk about the contribution margin. It's quite easy to calculate. It's your revenue less your cost of goods sold comes to your gross margin, less your direct operating expenses coming to your contribution margin. So that's how we calculate the contribution margin. And you'll see on the next page, this is an example in more detail of a schedule we provide to our users of the contribution margin. And you see it starts with revenue at the top. Then it looks at your cost of goods sold, which is, we call them the big four: chemical, crop insurance, fertilizer, and seed purchases coming to your gross margin. And we look at it as a percentage. And then we look at your direct operating expenses. And some of the big ones there would be your salaries, as well as your management and your repairs and maintenance, coming down to that contribution margin. So a couple of key assumptions I need to make you aware of on this financial statement. The financial statements are prepared on the accrual basis. And that's important because some of the things that implies is that means that your revenue represents the actual crop you produced during the year, regardless of whether you sold it off the field or you have it in the bin. That is the crop that you produced. In the same way, your expenses, they relate to expenditures to grow and harvest that crop. So there's a direct relationship between benefit and effort. To give you an example, if at the end of the year you apply some fall applied inputs, that will not be expensive this year. That'll be expensive the next year when you match it to the crop that you grow. So you can see from this document that it captures your key operating decisions: the crop mix, your pricing, control of your input costs. So as a result, the contribution margin is probably the best indicator of your success because you are influencing the majority of these numbers. I have a client where we break down this contribution margin actually 3 ways, because this one farm, it is comprised of a cattle component to it, of a crop component to it, and of a bees component to it. So we have a contribution margin for each one of those centers, and it can be quite competitive amongst the 3 brothers because each brother controls one of those areas of activity. So, they want to see how their contribution margin is doing, consolidated to the whole farm, but also looking at what their activities are doing. So I think it's important to have that contribution margin by various activity levels. So now that kind of concludes that part of my session. I'll come back a little later, but now I'll turn it over to Kayla, and she'll talk about the diagnostic review.
Okay, thanks, Mark. So I'm going to be speaking about the diagnostic review, which includes determining the overall health of the farm and some key trend analysis. So like Mark had said, we're going to consider this your annual checkup of the farm. As farmers, you are putting in so much effort and commitment, including long hours, stress over weather, and uncertainties with markets and rising input costs. Some of these indicators will be helpful to reflect on the success and growth of your farm. The key trend analysis will provide you with the financial data to assess the financial strength and understanding of your operations. Knowledge of your financial operations also allows you to assess business decisions, such as whether you're in a position to expand your operations and your ability to finance any additional debt. Ultimately, any success or challenges you face in your operations should come out of this financial data. As well, your financial statements should allow you to assess the impact of changes you have made to see if they positively influence your bottom line. The three key factors that we will go into more detail about are the shareholders' equity analysis, income before management remuneration, and key operating margins. So to start, we're going to talk about this shareholder equity analysis. If you treat your farm as an investment, this analysis will tell you whether your investment is increasing or decreasing in value. All information is reported on a book value basis, which excludes any appreciation in land values. However, it is still advantageous since it actually measures your efforts and excludes external factors that influence the overall value of your farm. Being dirt rich is only good if you can positively cash flow your operations to meet your annual expenditure requirements. For the purposes of this schedule, shareholders' equity includes personal shareholder loans and the equity balance from your company's balance sheet. In this example, you can see the growth year over year for this farm, and it's because they've likely had positive net profits, as well as they've left some of their shareholder wealth in the corporation. Next, we're going to talk about the income before shareholder remuneration. The purposes of this analysis is to give you an idea of the profits generated by your farm before it pays the key shareholders. Consider this the farm's T4. In farming, there is a fine line between what is needed to maintain the success of the operations and what is needed to maintain a certain standard of living for owners. When you look at this graph, we understand what you did to make the farm, or what you made before you paid yourself. So the next slide here, we're going to talk about the key operating margins. The ultimate success of your farming operations is reflected in your key operating margins. More specifically, your gross margin and contribution margin, like Mark had spoke about. And these are directly impacted by the operating decisions. Some of these decisions may include your crop rotation, your income input expenses, and labor costs. Many of these decisions are business decisions that will be reflective in the financial margins. You may do more soil sampling or apply more fertilizer in hopes to create better yields, or you may watch the market of the commodities and wait for a certain price. These are these business decisions for your farm that will reflect in these trend analysis and help you understand what areas are benefiting your farm financially. As you can see on this farm, this graph, some years kind of dipped low and then they continue to increase, maybe based on different decisions that were made. And these are good conversations to have with your accountants, as well as good analysis for you to see over the past 5 years. This overall health check allows you as producers to review your financial data over historical time. The trends will help you determine the successes and improvements needed for your farm.
Hi, everybody. So as Mark and Kayla have noted, knowing where you stand financially equips you to make more informed business decisions. To help you do this, you need to understand and analyze your financial information. Financial benchmarking helps farmers make better decisions by highlighting performance trends and showing them how they compare to other farms. Producers can look for insight from benchmarking against your own numbers as well as your peers. Using this information helps you understand your financial operational performance better and focus on areas where you can improve. Are there things that other farmers in your industry are doing better than you, and that with a bit of focus you could capitalize on this as well? Or if you're already doing comparatively well, where do you go from here? Do you add more land? Do you diversify? There are a lot of questions, and benchmarking provides a way to inject a lot of insight into answering them. A good place to start is to benchmark against your own farm over time to understand where you are, where you've been, and the trend you're heading towards. We've looked at trends with clients such as rising repair and maintenance costs and whether capital purchases may make sense. We use benchmarking to look at rising costs like fertilizer or feed and analyze whether producers are gaining or losing margin with those increased costs. We look at how numbers change over time with an investment. Recently, we've looked specifically at investments in robots for dairy farms and how that's affected feed costs, labor costs, and cost of capital, and how that all correlates. We look at what we call a 5% strategy, and the concept there is that focusing on small changes in your operation can produce significant results. I recently met with a farmer who consistently fell short on their gross margin by about 5% when compared to their peers. Their operation had around $1 million of gross revenue. So to quantify that, making changes to get where the benchmark is makes a $50,000 difference to their annual operating income. Looking at specific ways to target a particular benchmark can make big differences in the bottom line. Individual farms always need to be cognizant of the content of the benchmarks they decide to focus on. So if yields are affected by weather in a particular year, or maybe a new investment was made in that year that hasn't impacted revenue yet, the ratios can be unrepresentative of your farm's performance. So in general, it's best practices to analyze 5 years of data to gauge performance if the farm's in a relatively stable state. So our financial statements, like Mark showed, are strategically organized into 5 standard sets of costs and purposely separates managing operations and managing capital and finances. Proper analysis is a function of understanding both costs and revenue. It's not solely about controlling costs. Nothing's looked at in isolation. So maybe your fertilizer cost per acre appears high, but if the resulting gross margin is also above average, then we wouldn't point that cost out as a problem area. So on this summary page, what we're seeing with our farm clients are consistencies in their cost categories. With a click, we can easily drill into the detail in any cost category, and trends and potential problem areas start to jump out. This option is showing costs as a percentage of revenue. We also look at costs and revenue on per unit basis. In looking at different trends and the conversations with our clients, the thinking starts to broaden, and soon the results get used to run scenarios and do future planning, which is our goal. How do we use this information to look forward? So this chart here is showing the contribution margin on a per acre basis and easily lends itself to discussions around expansion as an example. So we've used this information with clients by taking their 5-year contribution average per acre amount and then use that to look at the viability of purchasing, say, another 200 acres of land. So we can compare the numbers to their projected debt payments and they then have a better understanding of the viability of their investment. And same goes for scenarios around taking on rented land and what that cost is per acre. So our goal is to produce meaning and understanding and context to your numbers. After obtaining an in-depth understanding of your own numbers, you can next compare with other similar farms to see potential red flags and set goals accordingly. If the majority of farmers are doing better than you on a particular line item, it probably means there's room for improvement. But if only a small percentage are better, you can likely only expect modest ongoing gains in that category, and you're probably better to look elsewhere for big scores. So you need to be cognizant of what you're using as a benchmark. For sure, you need to compare apples to apples, and always a multi-year approach is what we like to use to identify key trends. In some commodities, it makes sense to compare with producers across the country. In others, likely only a local geographical sample makes sense. So understand what you're comparing to. How the benchmark was established, the parameters or location around where that benchmark is coming from. So just as an example, I wouldn't ever just take a benchmark for the beef industry as an example. Benchmarks are very different between, say, a cow-calf operation and a feedlot. So you just need to know what you're comparing to. In my practice, I deal with a lot of mixed operations where they have a combination of different livestock and crops. So as Mark said, then we look for opportunities maybe to separate those out. And the analysis differs, but the value driven from the exercise remains valuable. I also like to consider whether you're comparing to an average number or comparing to the top. So we don't really strive to be average. I like to move towards looking at where the top quartile of producers are excelling, and then what can we do in our operations to get there. We know there are significant differences between the most and the least profitable farms in Canada. So quick results from just the numbers don't bring the true value. You really need to dive deeper. It really isn't about plugging numbers into a spreadsheet. So like I've shown here, it's about looking at your own trends, understanding your own numbers, looking at industry benchmarks, looking at operations versus capital, and looking at the relationship between revenue and costs. It's the conversations and the what if scenarios and discussions that bring real value to the benchmarking exercise. So our goal with benchmarking is to provide insight into the questions producers have and help them make informed business decisions to drive their operations forward.
Thank you, Lisa. So now I'll talk a bit about some financial ratios. And the financial ratios are important because they are basically the bank's report card. Any financing decisions is based on these ratios, and it will influence your current and future needs for financing. So this is really looking at it from the lens or the eyes of your banker. And we'll discuss 3 key ratios used by your lender to assess your operations. We'll talk about the working capital ratio, the debt service ratio, and the debt to equity ratio, all key components of the lender's analysis. And I have a question. I wonder how many producers here could take their financial statements and calculate their debt service ratio. And I would argue it would be a challenge for a few. And I'd also argue that this is probably the most important ratio that the bankers will use to assess your operations. Each ratio has a different time sensitivity attached to it. Each ratio has a desired threshold that the lender would like to see you exceed. So I think that's important to know. And lenders' financing decisions, whether to extend or limit your credit or your funding, will be influenced by these ratios. And some people will ask, well, why do I need to know about these ratios if the bank is going to tell me anyway? The bank is telling you these ratios because they know it's important to your success. So if it's important to your success, I would argue that you should have just the same amount of awareness of these ratios and how to influence them and change them to your benefit. So the first ratio that we'll talk about is the working capital ratio. The objective of the working capital ratio is, does the farm have the resources to meet its current financial obligations? When I say current, I mean within the next year. So it's short-term focused. You're really dealing with one production cycle within that year, maybe more production cycles depending on the subsector, and it is balance sheet focused. So I will give you an example of how that's created. So you see the financial statement there. It's you can see from at the very top on the asset side, you have current assets. That's the numerator of it. And then you look below under your current liabilities. That's the denominator of this equation. So you take your current asset, 897,000, you divide it by your current liabilities of 540,000 approximately. That gives you a ratio or a threshold of 1.66. So that's the threshold, or that's the number you're looking at. So you will take that number and you'll compare it to the threshold. And you can see in this situation here, the red line, that is the desired threshold that the bank requires you to exceed. So really what they're saying is that the current assets should exceed your current liabilities by a factor of 1.25. Now this, I did interview a few lenders with a crop scenario, and that was the threshold that they both like to see exceeded. So in this example, you can see from this form that it is at a factor of 1.66. So it is well in excess of the threshold, which means that it's in a good spot. This is a ratio that you really should stay ahead of, because if you sense a problem in this area, because it's a current problem, you need to contact your lender immediately, just to walk them through some of the problems you're foreseeing. Some solutions could include disposing of some long-term investments to create more current assets, maybe arranging for bridge or balloon financing to help you through your operations, or even lowering and extending some blended debt payments. Again, now that's reducing your current liabilities, all needed maybe on a short-term basis just to maybe get you through a tighter time. So the next ratio we're going to talk about is the debt service ratio. The objective of the debt service ratio is, can the farm generate enough cash flow to meet its annual debt obligations? I again would argue this is probably the most important ratio. This ensures the lender is going to get paid annually, and it makes your visits much better if you can achieve this threshold. And really, the calculation basically takes the cash profits of the enterprise before interest and principal payments and compares it to those same interest and principal payments that are due within the next year. So again, in talking to some of the financial institutions, they like to see a threshold of 1.25 again, which means the lenders wants the cash profits of an operation to exceed the debt obligations by a factor of 1.25. Again, this is a good feeling ratio, because lenders would like to see this positive over an extended period of time. It just adds to the sustainability of your operations. So you can see from this ratio here, in this example, the producer is going in the wrong direction in 2020 because they are below the threshold. So then now you're in the corrective action mode. So what you could do here is you could sell redundant assets that are not currently being used to bring down your debt. Again, you could extend terms on loans to reduce your annual obligations. Some of the caveats to this calculation, lenders will calculate this ratio differently. Some lenders will do it one way, some lenders will do it another way. So make sure you're on the same page as your lender as to how they're calculating this ratio. And different subsectors will have different thresholds. The crop thresholds will be different from the dairy thresholds, because the dairy are a little more consistent in their cash flows coming into the operation. So that threshold will be different. One of the scenarios we often see is producers trying to pay down their debt as quick as possible. One of the issues or problems with this is it leaves you vulnerable during down periods. And I guess I would stress to be careful to leave yourself some room for some unexpected storms. You know, that could include price fluctuations, inflationary pressures on costs, significant supply chain issues. We're seeing problems in BC now with the mudslides and the rain, that now some of the rail cars aren't moving. So we need to have the ability to weather storms like that. I had a client who always kept a certain amount of funds in long-term investments, and he called it his rainy day fund. Regardless of if he had debt on the books, he still wanted to have this investment here that was available to take him through the leaner times. And he, again, it was even called an emergency fund for him, but it gave him peace of mind to have that. So the final ratio I want to talk about is the debt to equity ratio. And this one, the objective of this one, does the farm have enough collateral to cover the debt? It's long-term focused, it's balance sheet focused, and I really kind of call this the worst case scenario ratio. What the lender is looking at here is how much skin do you have in the game versus how much skin the lenders have in the game in terms of providing you with financing. And some financial institutions have said that they would like to see a 1-to-1 threshold, which means the shareholders' equity is equal or exceeds the external debt of the farm. I call this the worst case scenario because if this ratio is on a steady decline, one of the things you may have to do is sell some of your productive assets to find more cash. I mean, you may have to sell land, you may have to sell quota. And I've seen that happen to some of our producers where they were put into that position because it just was going downhill. And most producers would rather cut off their left arm than to sell productive assets like land. So This is a really important one to watch over a long term to make sure that it is going in the right direction and you're making the proper decisions to make sure that it is going in that direction. So in the example that I have here that you can see, the debt would include, in this calculation, the debt in this case is your numerator. It includes your current liabilities and your long-term debt. So that's the top part of the equation. The denominator of this calculation is your equity, which includes the amount due to shareholders and the shareholders' equity itself. So those are the two numbers you're working with on this one. So when we go to the situation here, you can see that they're actually above the line. And in this case, you want your number to be below the threshold, because what this means is there's more debt being carried than equity. Now, this calculation we're showing right here, it's coming off your financial statements. So it's being based on the what we call the book value of your, for example, of your land and of your quota and of all your other assets as well. So in this case, it's taken again from the financial statements. So some things we should bring to your attention on this ratio is, if possible, can you show this ratio based on the fair market value of your assets? Example, property tax values may come into play if you think they're accurate. The quota value at fair market value could come into play, because the previous calculation again was based on book value. Often what we'll see is some of your assets on your balance sheet are valued higher than what appears on the books. For example, land, and again, quota could be significantly higher. We could have land on the books at its original cost of $100,000, yet it's really worth $1 million. So I think that definitely has an impact on your calculation. And when you think of it, when calculating that equity, when you bring fair market value of assets into play, it doesn't change your debt obligation side of it, but it does improve your side, the shareholder equity side, or your skin in the game, because those assets are valued higher. So I think that's important to look at. So you can see when we calculate it that way, that the farmer is actually in good shape, because they, at this point, the value of their equity is in excess of the debt that they are carrying. So we would say this producer is going in the right direction. So those are the three ratios that that I think are important for you to know. It's a good way to get on the good side of your banker, to know these ratios. And it's a lot easier if these ratios are all in a positive position to arrange new debt or new financial opportunities. We had a client who came to us and wanted to buy some land, and land can be as high as 10,000 an acre in some areas, or even higher. They wanted to say, was it worth it? So, and they were previously renting the land. So really what we did is we said, okay, in the year you had, let's go back to the beginning of the year. Let's take this land out as rent and put it in as if you bought it, and change the numbers, change your contribution margin if that was impacted by it. Look at your debt cost, look at your debt obligations, and what would be your debt service ratio under this new scenario. And we gave that information to them, and they made a decision accordingly. I have one producer that insists on seeing these ratios before they go to their bank, so that they can anticipate what the bank is going to be looking for and how they're going to be assessing their farm. So there needs to be some mutual respect of these numbers, of the lender and of yourself. So the final part I want to talk about are what we call I call them KPIs, or the key performance indicators. And that's the financial information that can directly influence your operating decisions. I think as a producer, you need to ask yourself, what are the most important decisions you need to make to ensure the success of your operations? And I think that's important to know. And then you need to know then you need to determine what financial information that is available to you to help you make those most informed decisions. Because first of all, from the standardized financial statements, you want sound numbers. And from those numbers, how do you manipulate them or work with them to help you with your key decisions? So when we look at, I guess, I call them key performance indicators, or KPIs, some of the things you should know about those, they do vary based on the subsector. For example, supply managed operations like dairy, maybe your key performance indicator is more focused on cost controls or productivity. In the crop scenario, you might be looking at contribution margin per commodity. So in the example that I'm going to provide for you today, we're going to take a crop producer and what they have determined as their key performance indicator. So in the next page here, you can see these are the key performance indicators, and it's the contribution margin per commodity that we're looking at here. So you can see from this example, you start at the top with the revenue of each commodity. We look at the direct or the big four expenses of a cost of goods sold. Then we come down to our gross margin. Then we look at our direct operating expenses, including machinery repairs and management salaries, and it comes down to a contribution margin. So it comes down to a dollar value contribution margin, but more important, it comes down to a per acre contribution margin, and that's what the user wants. So you can see from this example at the very bottom, soybeans have created an $81 per acre profitability or contribution margin, canola $16 per acre, and wheat $95 per acre contribution margin. So what we will do with some of our producers before we start this exercise, we'll ask them to what they think are the most profitable operations. And oftentimes we'll find that the actual ranking from this exercise is different from what the producer had thought was to be the most profitable crop. So that's something to consider. Some qualifications here. We know that, your short-term crop mix is really dictated by the rotation of your crops. But over a longer period of time, I think the individual results can impact your decision-making process. We have one client that's very interested in seeing this over a longer term, just to try and see a pattern as to where the his cost or his margin is going per crop, and he will make decisions accordingly. So I think the goal is to, again, look at your farming operation and determine what information is most impactful to the decisions you make that will lead you to more success. And each subsector has its own different KPI. So I, kind of look at it, work with your accountant to say what is best for you to look at. So that really concludes the session here in terms of the financial checkup. Again, what we want to do is we want to create some peace of mind, to do this either annually or when you feel the need, but to give an overall view of your operation to see how you're doing, especially in these uncertain times. And really, this is what we call our new normal. And I think there's going to be more exciting or challenging times coming up that I think the financial checkup could prove beneficial. So I want to thank you for listening to this session of the program, and I wish you a good day. Take care.